Friends, welcome back. Let us continue our discussion on the concept of optimal capital structure. Going to share my screen. Just give me one more second. In the previous class, yes, we are talking about these questions. Yeah. Features of optimal capital structure. What is optimal capital structure? We had already discussed. This is when you talk about optimal capital structure, let us recapitulate. It means the best debt and equity ratio. That is, it's the best combination of debt and equity. And at that combination, cost of capital. Cost of capital means the overall cost of capital or the weighted average cost of capital is minimum. Consequently, the value of the firm is maximum. That is what we call it as optimal capital structure. Right. So it is important to design a good capital structure so that value can be maximum. And for designing such a capital structure, one would need some information. You need what is the requirement of capital right now. That's the first thing. That how much capital is required, one should know. And how much is available. That is how much debt is available, how much equity is available. He has to plan accordingly. And what is the cost of these components? That means let us say debt cost is 9%, equity cost is 13%. He has to think about this. What is the cost? On that basis, he has to do the planning. Then what is the return? What is the rate of return expected from the investments? So he has to reduce the cost in such a way that that expected rate of return is achieved. So all this information he's supposed to know, then only he can design a good capital structure. Okay, a good capital structure should be first of all functional. Design should be functional. That means it should facilitate the day-to-day working. For example, let us say I need raw material. So that capital structure should be designed in such a way that whenever raw material requirement will be there, so money should be available. Let us say I need to, uh, I have a, let us say money will be generated in future. The capital structure should be designed in such a way that when money will be generated, that money can be used for repayment of debt, or that money can be used for servicing the debt. Okay, so it should be functional in that sense. It should be flexible. Flexible means whenever you want, you should be able to change the capital structure to suit the requirement. It should be adjustable. That is one of the feature of good capital structure. It should be in conformity with statutory guidelines. The company law requires certain provisions, certain things. For example, there are restrictions for taking debt more than the capital. So those aspects has to be taken care of. Okay. Now, if you summarize, there are many attributes of a good or well-planned capital structure. First of all, it should ensure that return is maximized. It should not affect the solvency of the entity. That means it should not capital structure should not involve more risk than it can bear, than the entity can bear. It should be flexible, that we have discussed, and it should be the capital structure should be designed keeping in mind the capacity of the firm. How much debt one can service. On that basis, he has to decide how much debt he should take. And control aspect, that means control should not be diluted. If you take more equity, control of the existing management gets diluted. That aspect has to be taken care of. Right. So these are certain components of capital structure: debt, equity, convertibles, etc. We have discussed all these things. If you talk about determinants of capital structure or various factors that govern the capital structure, here is a list for you. All these things can be referred to as determinants of capital structure. We had discussed everything earlier. We are recapitulating now only. Cash flow position, that is important. That determines if you are having excess cash, you may not be required to take any loan. Interest coverage ratio, to what extent you'll be able to cover your interest. You'll be able to service your uh, interest part. That is important. Debt service coverage ratio, not only interest, whether you are able to repay the principal part, that is shown in the debt service coverage ratio. That affects return on investment, then cost of each component, tax rate, what is the risk associated with each and every component, what is the risk associated with the business, and the dilution effect or the effect on control. All these factors are determinants of the capital structure. There are other factors also like flexibility, nature of the industry, stock market condition, cash flow timings and return. When you will be getting cash flow. Let us say you are getting cash flow, you'll be able to generate cash flow only after 5 years. Right. So if you take a loan which is repayable after 1 year, so you may not be able to honor that. So capital structure should be designed in such a way that the outflows or the expected outflows will match with expected inflows. Size of the company matters. The flotation cost also matters. Flotation cost means issue related cost. Let us say you are planning to issue equity shares. There is a cost involved in it. You have to, let us say, uh, involve something, let us say, something share issue cost. For example, you might have to print share certificate. You might have to print prospectus in certain situation if you are going to issue it to the public. Otherwise, also share issue agreements have to be drafted. So these issue costs with them. A regulatory framework, legal provisions one has to take care of. Then competition in the industry, one has to see what kind of capital structure your competitor is having. You definitely like to have a better capital structure. Now, finally, we'll come to this aspect. What are the problems with designing the optimal capital structure? We are saying all these things are good. It is good to have a best capital structure. And we know the theories which will be helping us to understand that how capital structure affects its value. Of course, there are certain limitations to these theories. Limitations in the theory, in the sense, some theory says yes, capital structure is relevant. Some theory says no, capital structure is not relevant for value of the firm. The value of the firm is not going to change because of capital structure. So that's a debatable issue. But practically, in real life situation, one has to see, one has to experience that thing. On that basis, he has to take a decision. But in coming to the real problems of having an optimal capital structure, first of all, first point is that there is no magic ratio. There is no magic formula which will give you that this is the best capital structure. And at this structure, value of the firm will be maximum. Nobody can tell you that thing. Right? So there is no magic ratio. So how can you know? You have to observe. As a finance manager, you have to observe that if I'm changing the capital structure, what impact it is having on the value of the firm. Am I having an ideal capital structure? If I change the capital structure a little bit, if I, let us say, adjust my leverage, what effect I'm having, how much reward I'm getting. Then the next problem is that the cost of each component keeps on changing. Debt cost is not constant. Equity cost is also not constant. And a good capital structure, optimal capital structure, largely depends on the cost, which is a dynamic, which keeps on changing. So every time you have to assess at this capital structure, what is optimal? At this cost of capital, what is the optimal cost of capital structure? If cost of capital changes, the capital structure or the optimal capital structure should also change. That is another problem. That how dynamic you are to adjust the capital structure. Third problem is that you have seen that capital structure is not so flexible that any moment you want, you can change it. You can pay back debt, add some equity, or buy back equity, or add some debt. It's not that easy. It's not that flexible. That is our third problem. Fourth problem here is that the continuous monitoring the cost, monitoring the value of the farm, and monitoring the capital structure is a difficult task. So these are, you can say, the basic problems associated with the capital structure. Right, friends, I think we got a fair idea that what is capital structure, what are its determinants of what are its determinants, and what is optimal capital structure. But while achieving the optimal capital structure, what are the problems associated with it? With this, we'll stop here. We are closing our third unit. We'll catch up with your fourth unit in our next session. Thank you. Thank you very much.